Hi, you guys. Welcome back. Today we're going to talk about tax loss harvesting. And with the pandemic this year in early 2020, we had a large opportunity to do some tax loss harvesting in our accounts. So let's take a look. We're at the State Street Global Advisors, the Spider People's page, and this is an article I found on harvesting losses in 2020. The market downturn has created unrealized losses in many portfolios. The one bright spot is that tax loss harvesting, the practice of selling investments in taxable accounts that have lost value to offset capital gains, can help reduce taxes. So there are some rules about tax loss harvesting. When you sell a position that has lost value, the loss offsets capital gains that result from selling securities at a profit during the year, as well as mutual funds' annual capital gains distributions. If capital losses exceed gains at year end, or if you didn't have any gains, losses can offset up to $3,000 of non-investment income, even though it is often taxed at a higher rate than capital gains are. Losses greater than $3,000 carry forward to offset capital gains and ordinary income over a lifetime. Swap or refine exposures. The IRS's wash sale rule prohibits claiming a loss on the sale of an investment if the same or substantially identical investment is purchased either 30 days before or after the sale. A tax swap can serve as a placeholder to maintain exposure to the asset class for 30 days. After 30 days, investors can decide whether to switch back to the original holding. So what does that mean? You could say, let's say you had a loss in an S&P 500 index ETF. You could switch it to a large cap ETF. As long as it wasn't a S&P 500, it would have a lot of the same holdings, but it would be a legal tax swap. You could also use the opportunity to do a couple of different things. You could mitigate risk with it. You could take advantage of a target opportunity. Let's say a certain sector was down that you were interested in, you could buy in. The other thing you could do is you could find a lower cost ETF or fund and you could balance into that. Remember, harvests happen when volatility strikes. If you wait until year end to harvest losses, investments that were down early in the year could bounce back into positive territory, i.e. 2020, you guys, resulting in missed opportunities to sell losers and book losses to offset gains. So the thing back in March, right, when we dropped down 30%, that was the time when I sold a couple of different ETFs and bought into similar funds and was able to capture those losses. Now, I don't usually sell my winners because I hold on to them, but if I had, I could use that to offset my capital gains. As it is, because I don't think I'm going to have any gains in my taxable account, I could use that money to offset $3,000 towards my income at tax time. Deriving the maximum value from harvesting losses requires basing your decisions today on a long-term view, both of the assets and your needs. So let's give an example. Loss amount. If a loss is less than $2,000 in tax savings, can be eroded by transaction and tracking costs. Holding period. The longer it is, the greater the potential for anything you save in taxes to reinvest into growth. This isn't something that works if you're doing it all the time, you guys. Day trading is not what we're talking about. If an asset is left will be left to heirs, then there's less of a need to measure the value of harvesting a current loss against the future taxes that would be due if the asset appreciates, because heirs will receive a step up in basis. Growth doesn't turn into a future tax liability. If you guys haven't seen my video on step up in basis, I'm going to link it up in the cards there. Definitely want to check it out. I've also made a video in the past, you guys, on tax loss harvesting and some of the exact things that involves with it. But this was just I found this video today and I thought, this has been a serious year for thinking about tax loss harvesting, because we did have a big drop back in the springtime. Now, if you didn't lock it in back then, chances are you've lost out, you guys, because we're pretty much back to all-time highs right now. But in the future. And remember, this only works in a taxable account. So if you're trying to do this you can't do this in an IRA, you can't do this in a 401k. But in a taxable account, if you have losses, sometimes it's best to lock that tax savings in, buy a similar but not substantially identical security, and you're never out of the market. All right, you guys, I hope you got something out of this. If you did, do me a favor, drop me that like. If you're new to the channel and you're not already subscribed, you know the deal. Hit the red button, ring the bell. You get notified whenever I make a video. All right, thanks a lot. We'll see you.